Hello everyone and welcome to Candriam's Coffee Break. This month we analyze a market environment that appears stable on the surface, but where significant dispersion is emerging across sectors, regions and asset classes. The macro backdrop remains stable, but market leadership is shifting beneath the surface. As shown in the table, since the late October peak in technology, US equity markets have experienced significant internal rotation. While headline indices appear broadly flat, leadership has shifted decisively toward energy materials and more defensive sectors, with technology underperforming. For the following chart, we highlight the increasing dispersion within technology itself. For the first time in years, 12-month forward valuations of software have fallen below those of semiconductors. This reflects a clear shift in market focus toward capital-intensive AI infrastructure rather than software-driven business models. The message is not broad market weakness. It is increasing differentiation across sectors and within themes. We remain positive overall on equities, but positioning reflects this growing dispersion. In the United States, we favor exposure to AI infrastructure, particularly semiconductors and hardware, where capital expenditure remains robust and earnings visibility is stronger. We are more selective within software, where competitive pressures are increasing. In Europe, improving industrial momentum and fiscal implementation, especially in Germany, support cyclical exposure. In Asia, we favor semiconductor leaders and export-oriented segments that benefit from global investment in AI-related supply chains. Overall, we maintain an overweight stance on the US, the Euro area, Japan, and emerging markets, but with a clear emphasis on structural themes rather than index concentration. Turning to fixed income, in Europe, we prefer core government bonds over peripheral debt and maintain a constructive view on duration, particularly through German bonds. Within credit, we favor investment grade over high yield. In the United States, spreads remain tight and valuations offer limited room for further compression. Returns are therefore increasingly driven by carry rather than spread tightening, and we remain neutral overall. Our strongest conviction remains emerging market debt, both hard and local currency, where yields are attractive, fundamentals are improving, and capital flows are stabilizing. On currencies, our stance remains diversified. We are neutral on the euro. We remain underweight the US dollar as global easing cycles broaden and relative growth differentials narrow. We are neutral on the British pound and on the Australian dollar, Canadian dollar, and Norwegian krone, while recognizing differentiation within commodity exposure. And we maintain a positive view on the Japanese yen as a portfolio diversifier in a more fragmented global environment. Thank you very much for your attention. We will continue to monitor these events and adjust our strategies as necessary.